Hi, I'm Tom Lydon, editor of ETF Trends here in Washington, D.C. at the Charles Schwab Impact Conference. And I'm here with Steve Cucchiaro, Chief Investment Officer of Windhaven Investment Management. Steve, great to see you.
Great to see you, Tom. I always enjoy when we get a chance to talk.
It's exciting, especially during these exciting times. So tell us briefly about Windhaven. You guys have ETF strategies that are available for individual investors and advisors. Is that correct?
That's exactly right.
Okay.
We do manage money for individuals, families, trusts. We also act as a sub-advisor for wealth managers, RIAs, multifamily offices. And in addition, we use ETF strategies even for some of the largest state pension plans in the country and other endowments, foundations. So we do have a broad client base.
Well, I know you've been doing great. Congratulations on your success. Listen, it's been an unbelievable year in the market. Equity markets, especially here in the U.S., have been outperforming. But there's also some threats of, is it getting a little bit too high, too frothy? Interest rate risk, those types of things. What are some of the things you're doing in your portfolios to take advantage of up markets, but also protect with the risks that might be coming down the road?
That's right. So right now, like you say, the U.S. stock market has been outperforming almost every other market and asset class in the world. Yeah. It's been outperforming for quite some time. You go all the way back to 2009. The U.S. stock market has outperformed international stocks, not to an unprecedented degree, but to quite a great degree, because the Federal Reserve Board has been a lot more stimulative here than the other central banks have been. Well, they're catching up, they're copying some of our money printing. We see the pendulum starting to swing now, where we're still favorable to U.S. stocks, but we've been adding more non-U.S. stocks to the mix, where Japan in January we added Europe, specifically Germany and the UK in June, and now for the first time in 4 years we're starting to see some of these international stock markets outperform U.S. So we do see opportunities changing. Sometimes we worry that investors always look with a rear view mirror and they see U.S. stocks have outperformed, and they might get rid of their international diversification just at the wrong time, just as things are starting to swing back to favor international.
What about emerging markets? I mean, they've drastically underperformed. Is that something you want to touch?
Well, since 2011, they really took a downturn relative to other markets. We had inflation problems, food problems, the Arab Spring, all these factors. People wanted to stay away. We had some emerging markets that now have developed deficits and they're more dependent on foreign capital. So in May, when Ben Bernanke announced the possibility of tapering, a lot of that capital started to flow out. So we think that it's been too risky to jump back with both feet in emerging markets. However, because they've so underperformed, their valuations are getting very compelling. And we think that once the monetary policy hurdles get out of the way, especially for those emerging markets that are not so dependent on foreign capital, there are going to be some compelling values.
You got my number, right? You're going to let me talk about rates. So interest rate risk on the fixed income side, probably the worst threats we've seen in 30 years.
That's right.
What are some of the things you're doing to protect investors as far as that interest rate headwind?
So we began to worry about sensitivity to rising rates back in the fall of 2012. We took profits on any overweights we had in tips and in corporate bonds in the fall of 2012. Some people thought that was premature, but the timing actually was quite good, because in 2013, the bond market has already been showing negative returns as rates are starting to tick up. So we have steadily, at every reallocation period, at every opportunity, we've been steadily lowering duration, which means that the fixed income that we do own in portfolios is much less sensitive to rising rates than typical duration. Also, we've been complementing our fixed income with other asset classes that should do well when interest rates go up, whether it's because of increased growth, increased inflationary pressures, or reduced confidence in the dollar.
You folks have been using ETFs for a long, long time.
For a long time, 1994.
Right, and advisors and individual investors have been embracing ETFs. For you, are there a lot of advisors that really enjoy ETFs but just don't have the bandwidth or the strategies, the back office, the liquidity, knowledge to be able to do it themselves?
We work with over 100 advisors, and these advisors do a fantastic job managing their client relationships, quarterbacking the entire financial picture for their clients.
Yeah.
don't necessarily want to reinvent the wheel and do all the asset management themselves, so they turn to outside sources. We have huge advantages in the ETF market. At our scale, we can do trading in a much more effective and efficient way on behalf of all of our clients, including all of our advisors' clients, by effectively trading the ETFs, by knowing which ETFs represent those asset classes the very best. It's not just all about annual operating expense, it's also about the liquidity of the underlying securities. It's about how well those companies track the indices. It's about how strong the underlying companies are that promote those ETFs.
Yeah.
So there are many factors. So we've enjoyed complementing the skills of advisors with our special skill in ETFs.
Well, again, congratulations on your continued success, and it's always great to see you.
Thank you, Tom.
Appreciate
Real
it.
pleasure being here.
Thank you.
Thank you.